Good afternoon and good morning to those on the West Coast. This is Bob Watson from the state of New York. On behalf of NAST and the State Debt Management Network, I would like to welcome you all to today's webinar intended to give you an update on the state of the bond insurance industry in today's municipal market. Today we have three distinguished speakers, each representing the current active bond insurers, those being Assured Guaranty, Build America Mutual, and National Public Finance Guarantee. Today's session will be followed by a question and answer period, and the entire presentation will be recorded and placed in the members section of the network's website for those who were not able to participate today and for those who may want to revisit the presentation at another time. Before I introduce today's speakers, I would first ask that Corey Donnelly from NAST briefly go over what you need to know in order to communicate with our speakers using the GoToMeeting webinar platform. Corey?
Thank you, Bob. There are two ways to ask a question. If at any time during the presentation you find that you would like to ask a question, you can either hit the raise hand icon, which is a small hand icon as part of the GoToWebinar platform in the upper right-hand portion of your screen. That way we know when the Q&A session starts, we will unmute your phone and ask you to verbally ask the question. You can also type in your questions in the question dialog box towards the bottom of the GoToWebinar software platform. If you type that in, we will ask those questions of the speakers. And you can do that at any time. Thank you, Bob.
Okay, thank you, Corey. Now I would like to formally introduce today's speakers. The first speaker is Chris Chapazeta, and Chris is the team leader for marketing and origination at Assured Guaranty. He joined Assured Guaranty in 2012 following a 20-year career in public finance at MBIA. He is responsible for public finance marketing, business development, and origination in all municipal sectors covered by Assured. Second speaker is Scott Richburg, who manages the public finance department at Build America Mutual, also known as BAM. Prior to joining BAM, Scott was the executive director and manager of the Southern Group for public finance at Morgan Stanley, with responsibility of all municipal underwriting activity in that region. Before that, he was a managing director of the U.S. Municipal Finance Department at FSA, and earlier in his career served in various capacities at Goldman Sachs and Payne Weber. Tom Weil is our third speaker, and he is the managing director and head of new business development at National Public Finance Guarantee. He is responsible for National's marketing and new business generation efforts in the U.S. public finance market. Prior to joining National, Tom served as Director of Municipal Research at Barclays Capital. And earlier in his career, he held various positions at GE Capital, Van Kampen Merritt, MBIA, and Smith Barney. Gentlemen, thank you for taking the time to be with us today, and I turn the floor over to you. And I believe Chris, you're the first speaker.
Thanks, Bob. I appreciate it. we want to start by giving an overview of the municipal market and talk about certain macro factors that continue to make a strong case for insurance in the municipal market. These factors continue to contribute to increases in insured penetration, which Tom's going to talk about a bit later. But just to put a little perspective on it before we get going, the first half of 2015 resulted in about $14.5 billion of insured product across the industry. In addition, about 1,100 insured deals across the industry contributed to that use of that product. The benefits of insurance, I think, is where we're going to end in terms of describing some of the key benefits that we see as issuers and investors kind of enter the market. So now a bit of an overview of the municipal market. It's very different from the corporate model. We're on page 2 of the slides. There are more than 60,000 issuers of municipal debt in the U.S. Versus fewer than 1,000 corporate issuers. So it's a much more fragmented market, as you can see, comparing the two numbers of 60,000 versus 1,000. 95% of these are small issuers who infrequently access the capital markets. So information flow tends to be less efficient than we see in the corporate model. and as a result, there's less liquidity. Municipal borrowing structures tend to be more complex than we see in the corporate side as well. This is driven by difference in call features as well as serial versus term bonds. Relative to corporate bonds, the municipal market tends to be less efficient as well. The availability of timely information and municipal disclosure contributes to that. Retail investors who value the protection provided by insurance own approximately 71% of this market. Right now, outstanding, there's about 3.6 trillion of municipal bonds outstanding, and again, 71% is held either directly by retail or 28% through mutual funds and as a result, retail. The average size of all bonds issued in 2014 was $31 million, again, across all sectors in the municipal space. The average size of all insured bonds in this space was about 14 million, which contributes to that concept of smaller retail pieces utilizing insurance in the marketplace. I wanted to talk a bit about issuer and investor benefits. Moving on to page 3, Corey, if you could. The benefits really become a win-win both for issuers, investors, and certainly the insurance companies. To start with the issuers, a lower cost of capital is the main primary reason anyone would consider using insurance. There's an interest cost savings, and that's realized up front for the issuer. Using insurance also broadens distribution to both institutional and retail. This makes transactions more efficient and saves, again, issuers money. Insurance tends to simplify the credit story for complex bond issues across the sectors, really, even from a GEO all the way to a transportation bond or an airport bond. Effective marketing for small, lesser-known names as a result of insurance is one of the main contributors of using insurance as well for an issuer. Increased access to the capital markets is also a significant benefit that issuers face, and certainty of execution. Many times you see choppy markets or headline risk in the market on a given day caused by macro factors or exogenous factors, and insurance tends to streamline that effect and provide a certainty of execution to the marketplace. The end users are also, get considerable benefits from the use of insurance as well and purchasing insured paper. They get an unconditional protection and unconditional guarantee of payment of principal and interest if there's ever a default by the underlying issuer. They also have superior credit selection in that the transactions tend to go through a rigorous underwriting process at the insurers. We've seen many cases out there as well where there's significant price stability on transactions where there's stress on a name. If the bonds are insured, typically the price stability and the value of those bonds tend to stay very stable even under stressful scenarios. There's a significantly enhanced liquidity in the secondary market for investors on insured paper. For example, an assured guarantee, approximately $400 million of paper trades daily in our name in the secondary market. We talked about simplifying the risk assessment. From an issuer perspective and an investor perspective, two things have to go wrong for an investor to lose money. Both the underlying has to default, and then the insurer would have to fail as well. So buying insurance is a significant benefit for investors because they have dual protection upon never losing any principal or interest. And then the last key benefit for investors is they purchase a surveillance and remediation team if necessary. From our side, we have a 40-person surveillance team that monitors credits on an annual basis. We touch every credit every year, and if necessary, we deploy teams for remediation and potential workout scenarios. With that, I'll hand it over to Scott.
Great, thanks, Chris. And Corey, if we could turn to page 4 of the presentation, I want to walk through the economics of bond insurance. All of the benefits that Chris just walked us through for the issuer and for the investor are really captured in what we refer to as the credit spread. That is the difference between the interest rate or yield on an uninsured bond versus an insured bond. That yield difference is the economic value that is generated by the inclusion of the bond insurance on a particular transaction. So for those of you who are issuers on the phone, and also I believe there's some financial advisors, the first question when you are evaluating bond insurance is, what is the benefit? How much do I save as an issuer for purchasing the bond insurance on my transaction? On page 4, we just have a very generic example of how it works, and then we'll give some current market estimates of what kind of credit spreads are being realized in the market today. And so for an uninsured bond, let's say it's a GO bond that has an A underlying rating, it might come to market with a 4% interest cost. If the issuer purchases bond insurance, the rating on the bond would go up to the AA category, and investors would demand a lower interest cost of approximately 3.8%. So that would be 20 basis points of difference. And in the box in the middle summarizes the economic value of the bond insurance. So if the overall savings, the gross savings, were 20 basis points, the cost of the insurance on an annualized basis were 10 basis points, then obviously the issuer is saving 10 basis points on a net basis by purchasing the bond insurance. And as Chris also mentioned, we're really focused on working with small regional issuers across the country. Over the last couple of years, these issuers have captured or reduced their borrowing costs by over $500 million on a present value basis. So there is significant value to these issuers by purchasing the bond insurance, and investors pick up significantly greater protections that Chris had mentioned as well. If we turn to page 5, what really drives the overall value and demand for bond insurance is obviously what's going on in the market, in the municipal market as a whole. Where are interest rates, and what is the current state for municipal credit risk in the market? So the diagram in the middle of page 4 gives a simplistic overview of how this works. In a market where interest rates are very low and municipal credit risk is very stable or perceived to be low, the demand for bond insurance is generally lower than average. I would say this very low interest rate market and a more benign credit risk market represented kind of the market in 2011, 12, 13 as rates were extremely low and municipal issuers were not coming to market all that often and being very conservative with their budgets coming out of the financial crisis. As interest rates have become more volatile, and I would say that we are starting to enter into more of this market, and there are greater perceived municipal credit risk, more municipal financial challenges in the headlines. Currently, we've all been reading a great deal about, Detroit dominated the headlines late 2014 and the beginning of 2015, and now the issuers that are commonly in the news for their ongoing credit challenges might be Puerto Rico, Chicago, State of Illinois, Atlantic City, Pennsylvania, now more and more information about the state of New Jersey. So as there's more discussion and press written about municipal credit challenges, the demand for bond insurance will increase because people generally invest in municipal bonds not for the high yields, but for the stability and the safety offered by these securities. I want to make one comment of another benefit that Chris did mention right at the end about the surveillance and workout situations. I'd like to really hand it to Chris and Tom and their teams at Assured and National. I think the Detroit water and sewer example really highlighted the benefits of having a large bond insurer involved in a troubled credit. Each of the firms were able to really work with the investors in the city and the investment bankers involved in the transaction and to help structure a restructuring of the water and sewer transaction, which really may not have been possible without a large voice and support from the bond insurers. And when you see bonds that are insured versus uninsured for challenged credits, you really see the value of the bond insurance. And I can tell you the investors in Puerto Rico, for example, who own the insured bonds versus the ones who don't own the insured bonds, who have direct exposure to Puerto Rico, really wish they owned insured bonds at this time. So I just wanted to make that point. Obviously, as bond insurers, we try to avoid those situations, but those situations do occur, and it really highlights the ultimate value of the bond insurance in times of stress. So I'll turn it over to Tom, and he can talk about the market and who is actually using and benefiting from bond insurance in the current market.
Well, thank you, Scott. And we'll move on to page 6 now, Corey. And on page 6, on the left-hand side, we look at the total market penetration historically going back to 2005. And as you see the red arrow coming down, that's a function of two things. It's a function, first of all, of the downgrade, so lower lines back in 2007, 8, 9, and the financial crisis issues that happened at that time. And then it stays low, the overall penetration stays low for a while because of low rates in the marketplace. I think as Scott just showed you on the page earlier, we were in this benign credit, low interest rate environment. And so in that scenario, bond insurance isn't in high demand. So we're now in a period where penetration is ticking up. I think it's ticking up because we have some volatility in rates. We have these credit situations, and as Scott just pointed out, the efficacy of the value of bond insurance has come through a number of situations, going all the way back to the Vallejo bankruptcy in California, Stockton, Jefferson County, Detroit. Investors are seeing the value, the bargain that they got when they got a lower interest rate in having those insured bonds. Now, as we look to the right-hand side, we see again, the insurable market as we look at it. And really, the way to think about insurance is it's really ratings arbitrage. What investors or what an issuer is getting is they're buying the rating from the insurance company and getting a lower rate for that. That's the arbitrage transaction they're making. And when the bond insurers back in 2005 to 2008 were all AAA rated, you could insure a lot more of the marketplace using that arbitrage. As the bond insurers have been downgraded and the market has stabilized at a different level, at the AA level for ratings, we've seen the penetration level off, and now we see it going back up. I think there are two things to note about that is, first of all, I think everyone in the market, Scott, Chris, myself, all believe that the penetration rate overall, really in the way we look at it on the first slide, the total market slide, it can go up to, by par value, somewhere between 15 and 20%. Investors do like to have liquidity. They do like to have one common source of information, one credit to evaluate versus the 50,000 in the marketplace. And as rates rise, it becomes less of an issue for an investor to buy the lower interest rate, higher rated bond. And so there'll be more demand for the paper. I think the other thing to note is that with only 3 competitors in the market versus 9 competitors pre-crisis, this is a good, healthy market for the 3 firms. If we move on to the next page, Corey, page 7. Here we look at the insurance market overall, and you see that the vast majority of the market is general obligation bonds. Well, then when you throw in tax back, we've got 70% of the market in GO and tax back credits. That makes sense. Bond insurance has returned to its roots of a core municipal transactions. Frankly, I'm a little surprised to see healthcare and higher ed at a combined 8% of the marketplace. It's just very difficult to underwrite a transaction in those sectors now. It's the economics are not there. The risk is higher in healthcare. So I'm surprised it's that high, but the market is what the market is. On the rating breakdown side, you see that really when you add up the different A-rated rating categories, 80% of the insured market is A-rated, next 17% triple B rated, and there was a small AA minus category of the market that does get insurance. Next page, Corey, page 8. And I think this is one of the biggest takeaways we want you to have today from this seminar. I think recently National put out a piece that we can send around or that's available on our website called Bond Insurance Stronger Than the Old AAA. And this goes for each firm on the call today. We are much stronger firms than we were back then. We are more conservatively managed. We have municipal-only portfolios. We have lower leverage. Rating agencies force us to hold more capital against our risk. And we have much greater transparency, and I think BAM is a good example of that. You see, when they started out, they really had a focus on building their website out and making it user-friendly. And back pre-crisis, when monolines became troubled, the one problem back then was that you couldn't see what their exposure was. You couldn't assess it for yourself, and so it was very hard to understand what was going on. That can't happen this time around. All of our exposures are up on our websites. A lot of detailed information there. Anyone can get in there. The other thing that we do now is by removing structured from our portfolios, we've removed a great deal of uncertainty that was there before. The structured finance deals could be accelerated, and the muni deals cannot. So even in a situation like Puerto Rico, which has people asking a lot of questions, but which we think is manageable, the thing to remember is that exposure cannot be accelerated, that if a claim comes to assured or to us for a Puerto Rico exposure, we're going to make that claim payment over time. We have very large investment portfolios and high earnings to help us make that payment over time. So it's a different situation than you had with the structured risk. And then the final aspect of that is that structured risk was a much larger percentage portfolio. It was 25 to 30% of the portfolios back pre-crisis. For us, Puerto Rico is 2% of the portfolio. So we have a lot smaller positions. Now that's still a large risk. After you move down from Puerto Rico, there's a lot smaller risk. And we're only doing, as a prior page said, about $100 million deals. The target market is not as big as it was. We're not doing $2 billion deals like we did pre-crisis. At this point, Bob or Corey, that's the end of the prepared remarks.
Thank you. Thanks to all three speakers. Corey, do you have any questions that are in the queue right now electronically, or any hands raised at this point?
We do. The Washington State office has a question. I'm going to unmute their phone. And can you all hear us in the Washington office?
Yes. Hi, it's Ellen Evans. Can you hear me?
Yes, we can.
Yes.
Oh, perfect. So I have first a comment and then a question. And first my comment, which is that I would hope that the presenters would speak with a bit more precision regarding the liquidity and disclosure characteristics in the municipal market. Remember, this is the state debt management network. It's largely states, although we've invited in a broad range of issuers. And I would take exception to some of the very broad characterizations that were in the first portion of this presentation. I think later portions indicated that the insurance penetration might be 15 or 30% or whatever of the overall municipal market. But as you all know, the municipal market is broad, and issuers have there are a number of different types of issuers. So so caution, please, with regards to characterizations of, we think our market is very liquid, and that our disclosure characteristics, our commitments are very strong. So that said, of course, insurance may be of great value and interest to some segments of the market. So when addressing those segments of the market, perhaps you could talk a little bit about how the cost of insurance, or how the pricing of insurance, how it's quoted to issuers, and how that is framed for them when they come to you considering insurance.
Sure. On the pricing side, it typically would be a benefit share. Our approach is we analyze the spreads on transactions, and as I mentioned on page 3, this is Chris, by the way, a lower cost of capital and interest rate savings is the primary goal of kind of the enhancement that we bring. From day one, if there's not a savings for the issuer to enhance that execution, again, most likely there's going to be an uninsured scenario there. So our goal is to have a benefit share with the issuer, and obviously the issuer has significant advisors, whether it's their bankers or underwriters or financial advisors to help them with the most efficient execution possible. But our approach is very typically, a benefit share with the issuer. Any, Scott or Tom?
No, and I think it's, Ellen, if your question might, it's quoted as a % of total debt service, and the three firms, compete. There's a process that we go through with either your banker or your financial advisors. And again, to your comments earlier just about disclosure, I don't think it was about poor disclosure. It is that investors, there are so many different municipal issuers, different type of structures, that the larger investors just don't have the time or means to dig down and underwrite a $5-10 million transaction, because it's not economic for them to have one of their research analysts spend a couple of days studying a small town in pick a state, and they might only get 100,000 in bonds from that transaction. And that's where the bond insurers really step in and increase the transparency and help educate the investors on the underlying credit quality of the municipal issuers that are coming to market.
Yeah, this is Bob. Maybe I can just supplement maybe what Ellen was saying too. Since our membership, it does consist of state issuers, which tend to be rather sophisticated, maybe relative to some smaller issuers that don't come to the market that often. I think there's been some sensitivity on the part of our membership regarding, well, primarily two areas. One, disclosure, with the advent of EMMA and with all of the continuing disclosure requirements the SEC has imposed upon us. There has been a tremendous effort on the part of issuers and the state issuers especially to make sure that we're in compliance with continuing disclosure and that we're as transparent as possible. With the issue of liquidity, as you know, there's been some pushback, and again, I think from the state issuers especially, on how liquid our securities are and whether or not they would be liquid enough to be purchased by banks, and due to some of the recent restrictions on what is liquid and what's not liquid, I think there's been some internal discussions within our organization about liquidity and how our credits are perceived. So Ellen, correct me if I'm wrong, but I think you're talking about some of the things that we've been talking about as state issuers, and that we feel that our credits are liquid in a lot of cases anyway, or most cases, and that our disclosure is, at least on the state level, is fairly robust. Is that what you're hitting upon?
Bob, as usual, you're right on target. Thank you for that clarification. And yes, those are very important topics for all of us. So right. What I was I'm sorry, can you still hear me?
Yes, we can.
Okay. So my only request of the speakers today was to focus on portions of the municipal market that might benefit from this additional credit enhancement, and certainly there are portions that would like to consider that. So it is a value, and we're delighted you're speaking to us today, but we don't, those of us who have larger portfolios that we believe and are demonstrating with the EMMA data are quite liquid, would like that to be correctly represented.
And Ellen, this is Chris. We totally agree with that, and your disclosure is excellent. Again, on page 2, that bullet point related to insured bonds, the last bullet point being, the average size of 14 million. As you know, many states aren't issuing deals that size. So I think, the comment was really referring to that, the smaller, lesser-known names, rather than really the excellent disclosure we're seeing at your level.
Thank you.
And Ellen, for everyone that's listening, we thought that it would be important to have this webinar and to talk about bond insurance, even though on the state level, many of you are rated at a fairly high level and may not necessarily require it. We do know that there's many states that have localities that are in stressed or semi-distressed situations, and you have other localities that may not be stressed but just don't come to market that often, basically don't have the liquidity, don't have name recognition, and may be on the lower rated side that would benefit from this. And some states actually do communicate with their local issuers, and some have oversight roles with their local issuers. I mean, in New York, we do have some oversight on our local issuers. So the intent was to try to bring local issuers to this webinar, but also we thought it'd be important on the state level officials, since they, in some cases, in some states, have impact or can give recommendations and suggestions to their local, issuers on ways to maybe reduce their debt service costs and possibly increase the marketability of their securities. And I think that's kind of the framework we were looking at in regards to this webinar.
And just one last comment, which is I couldn't agree more. It's important to be aware of and familiar with all the tools in the toolbox, and we all have different situations and different conduit issuers, and it's great to be able to spread the information. So once again, thank you for participating, and thank you for the clarification.
Good, sounds good.
No, you're welcome, and that's not to say that states, hopefully this won't be the case, but there may be situations where states do see some of their ratings start to deteriorate for whatever reasons. And there are some states that I will not name that are in some difficult situations that may require or may need some assistance, and bond insurance may be a product that might be able to help them. But that being said, I'll turn to the...
Bob, it's Chris. Just one final thought on that. Again, I don't necessarily, obviously don't want states to lower ratings necessarily, but, it's all about us and helping enhance the sale. And again, we saw recently, and again, there was money to be saved, which is one of the benefits we talked about just about a few months ago in May. We saw the state of Pennsylvania use us on a partial transaction. We insured about 99 million of it. And, the transaction, we enhanced the efficiency of the transaction. Obviously the state of Pennsylvania has very strong disclosure, and the transaction could have gotten done without it, but what Assured Guarantee did was we insured 99 million of, I think, a $275 million deal, and frankly the execution was enhanced.
Right, I actually have seen myself situations where an issuer goes out initially maybe without insurance, but then there's certain sections of the curve that are difficult to sell, and maybe there are certain investors that want insurance for whatever reasons. And so there are partial, certain maturities that are insured. I've seen that quite frequently.
Absolutely.
So I understand what you're saying. Thank you.
Thanks.
Corey, thank you, Ellen, for your input. I appreciate it. Is there any other questions at this point, Corey?
Yeah, we have a couple. We have a typed question from New Hampshire. The question is, what are the bond issuers presently experiencing in terms of the transaction breakdown between competitive deals versus negotiated?
Sure. I would say it's probably a 70-30 split of 70% of bond issuers coming to market through a negotiated issuance and 30% on a competitive basis.
Yeah, Scott, I agree with that breakdown. Obviously, a number of smaller transactions are typically sold in the competitive market.
Yep.
So we're seeing that, but there is a fairly wide range at times. And again, I think our portfolio mix for the first 6 months across, I don't know, we were at 700 deals or so. I think it was about a 70-30, 75-25 split.
Thank you.
Okay, you have another question, Corey?
We do, from North Carolina. I'm going to unmute that line. Can you all hear us in North Carolina?
I can hear you. Can you hear me?
We can.
All right. Hi, guys. My name's Dora Fazzini, and I want to turn the tables a little bit. I know we talk about disclosure as issuers and trying to help our localities as well with their disclosure. I want to find out what, if any, and this may have already been done and I don't know about it, but do you all have any plans of issuing continuing event notices by QSIP when something happens to you?
This is Scott Richburg. Yes, we've committed if something happens to us or our ratings that we will communicate on behalf of our members to the market and to the information services regarding that.
Okay, so in other words, you will be taking care of the filings in the future.
Yes, as an issuer, you are still responsible to making sure that happens.
Will you send us notices that you're doing it?
Yeah, we will be doing it. We've committed to do that.
Okay.
Yeah, and as Tom mentioned, every one of, this is Scott Richburg at BAM, every one of our transactions is posted on our website, and we actually publish what we call an obligor disclosure brief, which is a short credit review. It's 2 to 3 pages, but it includes key financial and demographic information about the underlying credit quality of the issue that we insured, and we update it on an annual basis or whenever the issuer has a financial notification. So if anything happens.
Yeah, do you file that with Emma?
We do not. It's up on our website. We are not a disclosure, counsel to the issuer, but we put it up on our website so that investors in those bonds can see it. But no, we are not a substitute for the issuer notifying Emma.
No, and I realize that, and it's one thing to talk about this at the state level, but it is another thing and another matter when you have a small issuer who may not be as sophisticated or as used to making Emma filings, trying to make their lives as easy as possible.
Correct, and that's one of the values that all of us bring, is we're trying to, bring more light to that smaller issuer, and that we assist them in communicating to the market as a whole with what's going on with their financials. And if they're late on a disclosure, our surveillance teams will contact them, and so it helps keep them kind of, keep them on track.
Okay, thank you.
So in essence, what you're saying is for some of the smaller local issuers who may not be sophisticated and in some cases may not necessarily have even high ratings, there's a benefit. Are you saying there's a benefit besides the economic benefit in basis points? There's also a benefit that they also have somebody else looking over their shoulder to make sure they're complying with what they need to do?
Yeah, because as the insurers, we are the ultimate investors in their bonds, so we're looking for that issuer to file and maintain proper disclosure. So when that doesn't happen, we call them.
And Bob, I think that's one of the key benefits that I think I highlighted earlier about surveillance. I mentioned we touch every deal in our portfolio every year. We have a team of, frankly, our surveillance team is as big as our new business underwriting and originating team. And, if there's an early red flag, I don't think the word is unsophisticated. That's probably not the right word. It's just these are smaller, lesser known issuers, and they have less resources, frankly, and less staff to kind of continue to monitor this and provide, good, solid disclosure to the market. So I think, that's one of the key benefits that comes from, on those types of transactions using insurance, which is consistent really with the writings in the past 6 months from the folks on the phone. Average deal size in the ratings was about $14 million for the first 6 months, and again, that's the type of size bond transaction and that type of issuer with limited staff and resources that really benefits from the insurance.
If your surveillance team contacts them and say there is lack of compliance, and they still do not comply, what as the insurer, what would you do then?
Well, I think every situation is different, Bob, but again, we would have certain rights and remedies in the transaction docs. We have the rights to certain amounts of information, et cetera, and we would obviously, on behalf of bondholders, in any way possible, exercise those rights and remedies and try to, assure a continued kind of strong relationship with the issuer, the insurer, and the investor.
Okay. All right, well, I have another question, and maybe it might be helpful for people that haven't ever procured bond insurance or aren't familiar with the process. Could you gentlemen walk us through the procurement process. Say an issuer decides they talk to their FA and they decide maybe bond insurance is an option they want to pursue. Can you walk us through the process, the timeline, and what you do on your end to determine whether or not you would want to provide the insurance and at a certain premium? If you could walk us through some of that, that would be helpful.
Sure, I could start off with that if you guys don't mind.
Sure.
The first thing that'll happen, Bob, is that frankly the FA or the underwriter will typically send a package to each of us. And the package will include official statement, audits, a debt service schedule, but deal documents to give us a good start on looking at the transaction and getting an idea of what the credit is. That will come into we have a general mailbox at National. I'm sure the others have something similar. That gets assigned internally. The internal analyst who it gets assigned to will then call whoever sent it in, let them know they're looking at it, and discuss time frame for answers. And so typically we ask for a week. I know most FAs and underwriters that we deal with typically send out packages with much more time than a week. Usually it's 2 weeks, some people's standard practice. We've done transactions as quickly as 2 days when there's been a hurry, but frankly, if there's a lot of transactions in-house, it's hard to process something any faster than that. So now that's just the beginning of the transaction. Now that analyst takes the transaction and starts evaluating the credit and looks at it and says, okay, this is an A- water and sewer in Pennsylvania, and then looks at other A- water and sewers recently, where they sell, did they get insurance, what was the insurance costs, what will the bidding environment be, and we'll typically have a conversation with whoever set the package in and talk about where we see the typical premium coming out on this transaction. We'll then take the transaction documents, put them through our process. We'll compare to medians or minimum standards and other factors that we have by type of transaction, evaluate it, come up with our own internal rating on the transaction, take it to credit committee, process that, vote on it, come back and communicate it to the underwriter, to the FA, whoever sent it in to us. At that point, we'll then go hard with a premium level, especially if they have the final rating. Sometimes we will get a transaction prior to the rating being established by the rating agency, and we'll work with an indicative or an expected rating. But for pricing purposes, we'll do our final pricing when they have the final rating. At that point, we communicate our approval, any conditions, and our pricing to the underwriter or the FA, and we wait to hear who won the transaction, or did it go uninsured. Anything I left off, guys?
I just have a couple add-on comments. I think those were all good, Tom. A couple things. We have a underwriting committee that forms and probably 3 to 10 times a day, depending on deal volumes in the marketplace, to help move this process along. We typically can do it. I know Tom mentioned a week, and then at times within 2 days. We typically try to respond in real time. Again, we need to do a full, thorough analysis, but at the same time, we have the infrastructure that really allows us to kind of respond in real time if necessary. But again, certainly any type of lead time is always preferred and requested on our side as well. And then the final point I'll make, and this I think goes for everyone, is there's no cost to getting a transaction looked at and qualified by us. So the way we see it is that it's a free option for an issuer to, potentially to look into the insurance option through their advisors. And frankly, there's absolutely no cost for the issuer, whether it's a local or state level, to obtain an insurance bid, obtain an insurance commitment, and then have that option as they head to market. It's a very efficient way to do that. And again, I had mentioned earlier, in a choppy market, it really provides certainty of execution. You could have a very strong issuer with very strong ratings, but the market could be choppy. The fixed income markets could be choppy on any given day because of external or exogenous shocks or external factors. And with an insurance commitment in hand and a price that would support the economics of using the insurance, again, I don't like to use this word a lot, but it's really a free option for issuers to think about as they come to market.
Which actually, as a follow-up question to that, in my experience of reviewing transactions that have bond insurance, we ask for a cost-benefit analysis, and it's typically provided by either the financial advisor or the underwriter. and I think depending on who you are, everybody has their own methodology and metrics on determining what assumptions to use. Besides giving them what your premium would be, do you give any indication to the issuer or the FA based on your historical experience and where you see credits trading with your insurance, any kind of indication of what the value would be, and do you provide any kind of cost-benefit analysis of your own that you would share with the issuer and its FA based on what you've seen the value of your insurance for comparable transactions?
This is Scott. I would say generally we leave the cost-benefit analysis and the interest rates at where the bonds would sell, insured and uninsured, to the underwriters and to the financial advisors to determine. In certain circumstances, if it's a unique deal and we might have insured something that would be similar to it, or all three of us track how our bonds trade in the secondary market. If asked, we may provide that kind of information to help if it's kind of a unique transaction and the underwriter would like to see more information about how a certain transaction might be trading. But generally we leave, as Tom mentioned, we provide our quotes so they know the cost of the insurance, and the underwriter has a pretty good idea of where they could sell the bonds without the insurance, and then also what interest rates they would be able to sell the bonds at with the insurance.
Yeah,
all right, thank you.
Yeah, go ahead. One only add-on that I have is, every week there's probably anywhere from 30 to 50 or 30 to 40 transactions that utilize insurance. So, the data points a week in advance are good kind of measures of the value, at any given time in the near future. So, we certainly share that information, but, our approach is similar to what Scott just said.
So do you actually publish material on your websites on what you perceive the value to be of for your insurance based on the underlying credits that you're insuring? Do you actually have published information?
No, I would say generally not. Some of us, or maybe all of us, publish and send around to a market a weekly kind of an update, and it lists what kind of transactions we insured during the week and what kind of credit spreads versus benchmarks they achieved. But generally we don't conduct the economic analysis. We leave that to the advisor for the issuer to determine that.
We at Assured, we also send around a weekly, and it has some of this information in it. But again, the market does change, really on a weekly basis. So.
Sure. Okay, I'm going to round back up with Corey. Corey, do we have any other more questions in the queue?
At this time, all questions have been answered.
Well, I'm going to ask a couple more just in case somebody is still thinking of one and wants to submit it or wants to raise their hand. So let me ask another question since we still have ample time and appreciate the time the speakers are taking with us. On your slide on page let's see, page 6, you're talking about the continuing what you believe to be the bond insurance penetration growing, and it shows going up to, I guess, going out to 2015. Oh, I mean to the current year. You're actually seeing the actuals till now. Do you have any insight, or what are your thoughts about where you think the market penetration would be for bond insurance over the next 5, even 10 years? What I'm sure you'd like to see it increase. I mean, it's you like to see your business model, your business do well. But based on the market today and reactions you're getting from various market participants, are you projecting any other trends going forward?
Well, this is Tom Weil again. Bob, thanks for the question. I think the way we look at it is the main driver of market share right now, or penetration, has been low rates. So as rates rise, we see increasing penetration. If you went back to page 5 in Scott's in-depth discussion stable markets versus volatile markets, heightened credit risk markets, and the efficacy of the business model in that type of marketplace. I think we're starting to see that come about. So I think we're all of the belief that double-digit penetration rates in the overall market make a lot of sense. I think it's hard to say over what period of time, but certainly you see we're coming off of, sub 4% penetration in 2012, 2013, and nice increases in 14 and 15. So I definitely think it's a 15 to 20% market once we're reestablished, once people understand what I mentioned earlier about the piece we put out about the fact that we are actually stronger companies than the old AAAs, even though we're now a AA industry. So I think I think investors, when they're looking at 50 to 60,000 different issuers in the market, they can understand the states, the big credits, and they have big exposures to them, and they'll take a lot of time at that. But the smaller issuers, they really do like to have help with. And part of my background, I spent 20 years as an investor, 4 at one mutual fund firm, 16 in another, and I know that we really did value the homogenization of credit that bond insurance brought to the marketplace. And so I think there's a level, it makes a lot of sense to come back to. I think it's double digits. I believe it's 15 to 20%. I think that's healthy for the 3 firms that are in the marketplace. And it's just a question of how long does it take to get there. The faster rates rise, the quicker we get there. That's not necessarily a good environment for everyone else, though.
Yeah, at Assured, we agree with those numbers. The second quarter brought about 8%, Bob. We think it continues to, incrementally go up. Could we see 10 by the end of this year? Certainly. Again, to Tom's point, our view is as rates rise, the economics and the math become easier to kind of work from both the issuer, the investor, and the insurer perspective. The other thing, there's a couple other contributors. I think the other one would be, it's credit choppiness out there, and obviously at the state level, it's fairly highly rated. But we do AA credits here at Assured. We do insure them. So that I think as you continue to see credit choppiness out there across the 60,000 issuers that potentially could come to market at any given point in time, I think that will contribute to increased use of insurance and penetration. And frankly, I think the other contributor will be the outreach programs from the 3 folks here represented by the 3 insurance companies here. Frankly, we're aggressively out there, and I know my competitors are as well, helping to educate the market on those true benefits that we talked about earlier.
Thank you. All right, I have 2 more questions, and then I'll turn it over back to Corey to see if we have anything else, and if not, we can conclude. So let me just ask a couple more questions. When I'm looking at insured deals, and trying to determine the value of the insurance, we hear from underwriters that, well, of course, investors look through the insurance to the underlying credit sometimes, and they will factor in the credit quality of the underlying credit, and depending on the creditworthiness of the underlying credit, that could have an effect on the real value of the bond insurance. And I was wondering if you could speak to that point. I'm assuming the bond insurance would carry more value potentially, depending on the creditworthiness. It could vary. I think the value of the bond insurance, depending on the creditworthiness or the credit, the strength of the credit of the underlying issuer, or the underlying credit. Can you talk about that a little bit?
Sure, Bob. This is Scott, and this kind of gets back to the points I was making on page 4. About the credit spread for different underlying credits, and the example I had used was an A-rated underlying. So I think for a AA minus type credit, the overall benefit would be in the 5 to 10 basis point reduction in that borrowing cost. In the A category, it could be 10 to 20. And I think the point you're bringing up, 2 different issuers that both might be rated A could be perceived differently in the market, even with the bond insurance. One might have a stronger name, even though the ratings might actually be the same. So those bonds might sell at slightly different interest rates. And then if the bond has an underlying rating in the BBB category, then the bond insurance could reduce that issuer's borrowing cost on a gross basis by 20 to 50 basis points per annum. And so, but, you know, bond insurance is, as Tom had mentioned, kind of gone back to its origination, where it is a credit enhancement. And I think in 2004 and 5, it became more of a credit replacement, where you know, some people might have solely looked at the insurance and not spent enough time or any time looking at the underlying credit. And I think that's what you're hearing more and more from the underwriters that you are working with on transactions, is that the investors will look at the underlying credit and do their work there, especially if they have credit research staff on board, and then add the value of the bond insurance on top of that.
Okay, that makes sense. I appreciate that. Thank you. And my last question is, can you tell me how often the rating agencies actually come and talk to you and kind of look at your portfolio and basically either affirm or assess your rating? How often do you go? What is your cycle like with the rating agencies?
Sure. We all go through an intense annual review, but where we sit down, senior executives of each of our firm will go and meet with the rating agencies on an individual basis, and they will go to credit committee and review our entire capital position, business position, everything, and then publish an updated credit report on each of the companies at least annually. But all of us are in constant dialogue with the rating agencies. They are seeing the transactions that we are insuring. They are familiar with the portfolio of credits that we have all insured historically. So I would say it's a fairly constant, you know, oversight review of with the rating agencies looking at each of our firms and our ongoing and growing portfolio. But we go through an official review on an annual basis. And generally those reports are published in June, July. So I believe reports on all of us were just published within the last month to 6 weeks.
Yeah, June 29th.
I think exactly. Yep.
So there you go, June 29th.
June 29th.
Very good. Thank you very much. Corey, how are we doing on your end?
We don't have additional questions at this time.
Okay. I guess we can wrap it up. And before I give concluding remarks, you know, if there's any key points that any of the speakers want to leave with our participants today, now's the time. I mean, I appreciate your time. And do you have any key points you would like to, you know, if you had to sum it up in like 2 or 3 bullets, what one of you want to take a stab at? What are the key takeaways that you would like people to know?
This is Scott. I'll just make a couple of comments. One, just on logistics. At the end of the presentation, and the page is up on the screen, all of our contact information and our company websites are there. So if you want to learn more about each individual firm, please go to our website or feel free to contact the 3 of us who are on the phone. You see our contact info. And I think the key takeaway is really the points that Tom made, that the insurers, including the 3 of us who are active in the market, are significantly stronger. All of the firms learned significant lessons from the financial crisis and have incorporated those lessons into the way that our firms are either structured, what kind of business we do, how we go about our business, how much capital we keep against each dollar of risk that we have. And so, although the ratings for the industry are in the AA category, as Tom has mentioned, if you compare the firms side by side to the companies that were active before the crisis, quantifiably the firms are all stronger and operated much more conservatively, and investors are seeing that value, and that is really the driving force behind the increase in the use of the bond insurance, as that investors are placing more and more value on the guarantee, the surveillance, the increased liquidity, and all the benefits that the insurers bring, and that derives the savings that we're able to pass on to the issuers.
Yeah, and the only thing I would add would be a couple of things I mentioned earlier. There is, it's a very effective tool. It's a very effective tool to have at bond sale, and it should be viewed as credit enhancement and in no way credit substitution. There's no cost to have a commitment and a price, as you enter the market, and if it makes sense from your advisor's perspective and from your perspective, I think it could be a very important way to efficiently, head to the market and enhance execution.
Then the only thing I would add is, if you go back pre-crisis, bond insurance was this mystical corporate structure. There was no transparency. Now, that's one of those lessons learned that Scott's mentioned, is that people have to be able to see what our portfolio looks like. If there's events happening that affect the firm, all the constituents that are part of our business network need to be able to see what's going on with us. And so I think we've all learned that lesson. We're a lot more transparent. Our portfolios are up there. The websites are easier to use. Selective exposures, the important names that people are talking about are out on the websites. And I think it's a lot easier to understand us now than it was pre-crisis.
Well, fantastic. I mean, it sounds like, the fiscal crisis was a lesson learned for many municipal market participants, and, and it appears, and based on your conversation here, that, the insurance industry is one of the participants that had to kind of retool and rediscover business models that would make it work going forward. So we appreciate you, again, on behalf of NAST and the State Debt Management Network. I want to thank you for the time and effort in putting today's presentation together. As we stated, the bond insurance industry has gone through significant changes since the fiscal crisis, and your presentation was helpful in really updating us on the status of the current insurance market, bond insurance market, and I think it's helpful as we go forward and look at our capital plans and our borrowings going forward, both on the state and local level. So thank you very much. Finally, I would just like to end with it by putting in a plug for our next webinar being planned for mid to late September. This webinar, which will be facilitated by Mark Pascarella in Indiana, he will be talking about the financial impact of P3s on states, and he's looking to have a panelist consisting of rating agencies to discuss their viewpoints on this topic, on how P3s affect the states and their financials. That's it for today. Again, thanks to our guests, and thank you everyone for participating. Have a good afternoon, and enjoy the rest of the summer. Take care. Bye-bye.
Thank you.
Thanks a lot.